May profits be upon you. Welcome to another weekly Forex Forecast. We're looking at the pound cable, all right, pound USD. First, the economic calendar for the week ahead says there's no red folders on Monday. On Tuesday, very important day, the most important of the week, we have core CPI in the US. Man, this is a high impact news item. All right. If it comes in soft, that means the US dollar will be weakened. If it comes in a little hot, uh, that'll strengthen the US dollar. And you'll see it go up against its counterparts. All right. There's also a Royal Bank of uh, Australia uh, having an interest rate decision to make. And Wednesday, we're going to see some good liquidity going to the markets. Hey, Thursday, PPI for the US. That's going to be a pretty big one as well. All right. We have a good week ahead as far as liquidity juice flowing in the markets. Let's look at the pound USD chart on the monthly. Let's mark it up. Let's do it right now. All right. What we see here are marking now is breaks of market structure. All right. Breaks of market structure to the upside. All right. These are bullish breaks. That means the market is making higher highs and higher lows. Higher high, higher lows, higher highs, higher low, higher high. All right. Now, what would we naturally look for? Well, a retracement to make what? The higher low somewhere in this leg of structure. Okay. Whoops. All right. So let's look at that leg of structure. Where would we most likely find it? Well, let's put a Fibonacci retracement tool on it. This is the monthly, remember now. All right. From the high to the low, from the low to the high, high to the low. All right. And you want to look at that 50% equilibrium of this trading range. Above it is premium prices. Below it is discount prices. You want to take your shorts from premium prices. You want to take your longs from discount. Easy enough, right? Those give you the highest probabilities of success. Now, where in this leg of structure can we expect the market to retrace to in order to find support for higher prices? Well, I'd look for fair value gaps. Now we have a fair value gap here. Oops, didn't even do that. We got a fair value gap here, but this one's above the the equilibrium, the 50%. uh, Optimally, we want to be below the 50% in order to catch prices going up high. But what we have here, these sell to buy wicks here on the lower time frames, that there is an area of demand. All right, this will form an order block, and let's see what we're talking about. Let's just go on down to the next time frame, the weekly. Now, again, this is the monthly fair value gap. That's right above the 50, but you see the sell here before the buy. This is an order block, folks. And here you will find uh, an area of fair value, right? Um, what you're going to find is right above. You want to see a displacement when you have an order block. You want to see it displaced the opposite direction. Without that displacement, where there's an inefficient movement of price to form a fair value gap, I don't depend on that area to hold price if price should return to it. That's the first thing. All right. So I want to also point out liquidity. There's a equal lows here that will form a very nice draw on liquidity. All right, I'm going to move this monthly fair value gap because we know that price is probably going to head down into this area, the sell the buy wicks. All right, I'm going to divide it up into four quads here. Hold on a second. Stick with me. And what I'm looking for is if price pulls back into the 50% area, this is where I would want price to hold for higher prices. So we have some short-term bearishness because we want to complete this pullback, this retracement, the correction to that impulse. All right, this is the corrective move, and then we can continue higher from there. And I want you to also bear something else in mind. This is the makings of the market maker sell model. All right, why? Look at this. This is a change in the state of delivery. Price is changing from a bullish market to a bearish one as it crosses this line. When you see price close below that last manipulative leg of structure that goes up, and then once we go back the opposite way and close below it, well, that is a shift in the market. Got it? And we'll probably be heading towards these relative equal lows as a draw on liquidity. Yes, you say, oh, this was a bullish candle on Friday. It closed bullishly. All right. Well, take a close look too. I want you to catch these little details. Did it close? Did Friday's candle close above Thursday's candle? No, it did not. It closed within the range of price. That would indicate that the next candles will probably be bearish. Probably take this high. It'll probably take this high with a wick and then turn around the other way. We're talking about probabilities here, right? Had the candle closed above, then we would be thinking bullishly, and price would probably continue bullishly from there. But that's not the case. All right, and you see how the sellers stepped in here, bringing price all the way down, and then we have this retracement. So with that movement, this is what I do. I put the Fibonacci's on it. And I said, what kind of retracement did we have here? We went past 786. My goodness. We're in this territory. We need either price is going to open up and start to move down immediately, or we're going to go to the 50% because the body is extra small and this wick is extra long. We're going to go to the 50%. I'll use this. We're going to go to the 50% of that wick. With the next candle, we'll wick up to it. We're going to look for it to respect that 50% and come down. That's what I'm looking for. Doesn't mean it's going to happen. I'm just looking for it. All right. I want you to see that there is a bearish fair value gap here that was respected. Here. And you see the follow through. Price retracing up. I'm looking for that retracement to end, and then we can come on down. I don't want to see it get past the 50 to 60% of this wick. All right. Now, if we go down to the daily, what do we see? This is where things come a little clearer. This is that move up, right? The last bullish leg in this market maker buy model. Okay. And we swept liquidity, and then the market finally dumped, closing below and trading below that the low of this bullish candle, this institutional impulsive move here. All right. And we have a retracement into this latest bearish leg of structure. What I want you to do is put your Fibonacci retracement tool, and you'll see where we're at. We came right up into the 618 and 705 right there. All right. I'm looking for price to start to turn over here. One of the reasons why is because we're above the 50%. So I want to take my shorts from, that's right, premium prices. All right. Because we're in premium price of this range. All right. The other thing is, let me show you this, is there is a bearish fair value gap here. And what happened with the last fair value gap? This is a weekly fair value gap. Remember that. There's a weekly fair value gap here that price went up into, respected, and shot down. All right. There is a bearish fair value gap in there as well on the daily, nested within that fair value gap on the weekly. But price pushed up into it and came down. I'm looking for price to show respect to this fair value gap that it is now in contact with. All right, you're with me on that? Good. All right, and we have the draw on liquidity down at the bottom, the sell side liquidity here of those relative equal lows, and here we'll find the remember the sell to buy wicks. This is that area of demand that has formed. It is an order block, folks. It is an order block, and we can refine it this way, where the sell and the stronger buy intersect, and we can stress that over here. The draw on liquidity right above an area of demand is a strong draw for price. And I'm looking for price to make its way down here and find support once it does. So we have some short-term bearishness coming into this market. That is my belief. All right. Now, CPI will have a lot to say about that on Tuesday. So be careful of that. Some people are going to wait. These are wise people until after the news announcements, because the markets can tend to consolidate prior to a high impact news item like CPI or NFP or FOMC. Those items can have the potential to reverse markets. So you want to be very careful to be clear of trades or manage aggressively if you are in one at the time of the news. All right. If you have any comments, leave them down in my comment section. I respond to every comment that my viewers leave. All right. If you like what you're seeing, make sure you hit the like button. Make sure you hit the boost button if you want to see me continue to put out this free information. All right. And thank you for watching. Hey, I put out one for the US dollar index and the euro prior to this video. So make sure I'll leave you some links for it in the related videos, or in the in that section underneath this video, or in the comment section. So just check that, and make sure you go and check them out, because especially the US dollar breakdown. That analysis lets us know what to look for with the majors, the major forex pairs. All right, because the US dollar is the important, the most important thing there, and we have some heavy duty news coming down the pipe. All right, I'll see you in the next video, and thank you for watching.